Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we'll break down today's trading action as investor anxiety over tariffs continues to weigh on sentiment. Plus, we'll bring you the latest read on the U.S. economy with fresh economic data crossing the wire right now. And we're going to break down how artificial intelligence is impacting the labor market as Meta, Microsoft, and Disney all announced job cuts. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages here, we have some movement to the upside, a little bit of a kick up there. You've got your tech-heavy NASDAQ up 0.4%, your S&P 500 up just above the flat line here. Flipping it over to the bond market here, taking a look at yields moving to the downside, perhaps a reaction to some of the economic data that's crossing the wire right now. And finally, we're going to take a look over at Bitcoin moving to the upside, and it's up above 105,000, up over 1.5%. I want to bring in my guest host for the hour, Stephanie Roth, Wolfe Research Chief Economist. Stephanie, we've got some breaking news crossing the wire here. Job openings and labor turnover data. So let me break that data for us. The job openings labor turnover survey coming out right now, coming in a touch hot. The survey indicating 7.1 million open jobs, coming in just above that at 7.39 million here. So that is a beat again of that estimate here. The prior month revised to 7.2 million. That's a revision upward for job openings. Also the job opening rate coming in at 4.4% versus the prior month of 4.3. Also interesting to look at the quits rate, an indication of maybe how stable the broader market is, coming in at 2% versus the prior 2.1%, so just a tick lower. 1.786 million workers fired or laid off. That is also a tick up. So let's break down all of the data I just talked through with you, Stephanie. Talk to me about how you read this latest JOLTS report.
Yeah, so when I'm looking at this report, I pay most attention to the quits rate and then the layoffs rate as well. The openings rate, sure, it's important to pay attention to, but that can be a little bit more flimsy of a measure. It's easy to post a job opening, but a quit is something that's tangible. If you really feel good about your job, you're more likely to quit, and you're likely to stay put if you're concerned about the outlook to some extent. So we did get, the moves are very modest. We got a modest tick down in the quits rate, which just signals at the margin a cooling off economy. Also important to notice, this is an April print. This is a slightly backward-looking report compared to what we're going to get on Friday, which is a May release. Yeah. So we already got the signals of the labor market for the month of April, and it was still kind of fine.
Yeah.
The layoffs tick up is something to keep an eye on, but it's still fairly low. But this is something that we're going to be watching closely, and to the extent that claims did tick up a little bit most recently, this is going to be an important thing to keep an eye on.
And to what degree does some of the data that you're seeing here feed into the non-farm payrolls print later this week?
Yeah, I mean, this is an entirely different survey, so it's important to keep an eye on the fact that this is a very much an independent measure of the labor market. It's not seen as important of a release. Again, like I mentioned, it's slightly backward-looking, but it filters into the overall mosaic of the labor market, and it just tells you that so far the labor market seems to be okay. We're not seeing any dramatic moves in either direction. Base cases, we'll start to see a gradual slowing throughout the course of this year of payrolls growth, that we're going to get a slowing below 100,000, which is an important indication. And this is going to be driven largely because of immigration slowing down, rather than a real cooling of the economy.
Yeah, and that's something else that I want to talk to you about later on in the hour. We're going to talk about AI, and I want to get your thoughts on how immigration plays into the broader impact on the labor market here. I also do want to talk to you about the factory orders here. The survey indicating a decline of 3.2%. We actually saw a 3.7% decline in factory orders. Durable goods orders coming bang in line with estimates of a decline of 6.3%. Talk to me about that fall off in factory goods orders and durable goods orders. What is that signaling to you?
It's not something I would worry about too much. We got a big pull forward of demand in the month of March, and then you got a drawback in the month of April. This was volatility around tariffs. So I wouldn't spend that much attention kind of to this report. I wouldn't be too worried about it. In thinking about this report, the most important component is going to be your capital goods orders, non-defense ex-air, and shipments, same thing. And those are not that different from expectations. This is the final read for this report. We got a preliminary read earlier in the month, and the data aren't that different from that.
And I am curious, because you said something important in there about how the data is kind of backward looking, and we can kind of dismiss certain things because, oh, tariffs were in place and it was pulled forward, but then, oh, the tariffs are potentially going away, so then no data is important. Like, how do you find clarity on what data is actually important and accurate?
So I think there's a couple of things to consider. One, there was real concern that the tariffs would tip the economy into recession. Now that there's been a dramatic U-turn from the tariff perspective, I think we just have to look through a lot of it and smooth through the noise and just look at what the fundamentals of the economy are doing. Now, from March to April, there was a lot of volatility in the news. So it's going to be difficult to truly smooth through that. We have to just remember that there was a lot of pull forward in March, and you get a bit of an air pocket in April. So I would look at a 3-month average of the data as we move through the next couple of months, because that'll help you smooth through a lot of that volatility. It's going to be difficult, and it's going to be really hard, and the summer period of time is where you tend to get a lot of seasonal volatility, more so in the labor market, but it's going to create a muddied picture of the economy. And I think the thing to keep an eye on are people employed, and if they are, they're going to continue to spend, and that's been the case. The labor market has held up well, so the expectation is the consumption backdrop should remain okay as long as the sort of the dynamics of the labor market are still fairly firm.
And to that end, what are you anticipating for Friday's jobs report?
Looking for 115,000. Consensus is closer to the 130,000, so a little bit below, but it should be okay. And we need to get accustomed to the jobs numbers coming in a lot slower than where we've been.
Yeah.
So we've been running, well over 200,000 for a lot of the past couple of years. And that was, one, just catching up to the sort of the pre-COVID level.
Yeah.
And then it's also been immigration. The foreign-born labor force has driven a substantial portion of those gains. And now we're sort of closing the borders. And not only are we restricting the flow of people coming in, but also the stock of people, the people that are here, their visas are going to become expired. A lot of them who were here under Biden's parole programs. And these were programs that Biden brought in about 75,000 people per month on an ongoing basis, and we stopped the flow of those people from the programs, but also as those people's visas come due, the administration is not gonna extend them. And they're even trying to extend, to end a lot of those visas all at once. So Cuba, Haiti, Nicaragua, Venezuela was one program, and the Supreme Court just ruled last week that they can terminate all of those visas basically all overnight.
Yeah, and that, of course, to your point, is going to have a significant impact, one that we will be able to talk with you about to get some clarity. Thank you so much, Stephanie. You're going to stick with us for the rest of the hour here, but let's switch gears a little bit. Earnings season is almost over, and outlooks are actually improving. Analysts have stopped cutting their earnings estimates in the past few weeks. So what does this mean for markets? Joining us now, we got Kelly Kowalski, Mass Mutual Portfolio Manager. Kelly, really appreciate you making the time for us. What exactly is driving this renewed optimism, or at least decline of pessimism, about earnings growth for the rest of this year?
Well, good morning, Madison. Thanks for having me. I think that we've seen sort of as Stephanie remarked earlier, a big sort of U-turn from the administration in terms of a softening in policy. More encouragingly, we've seen an administration that is reacting to data and markets to some degree. So it feels like we've escaped from the worst case scenario. And I think if we can sort of get more clarity on what the trade situation is going to be, what this bill is going to look like, we may be able to sort of muddle through the next few months. If you look at overall S&P earnings, we're down to about 7% for the year. So there is some sort of already of that tariff sort of downside and the policy uncertainty baked in at this point.
And when you think about that policy being baked in, is that true across the board for stocks? I was reading a note this morning that tried to kind of differentiate between consumer-facing stocks versus CapEx-facing stocks, those big tech stocks that really rely on just company expenditures. Is it true for both of those different groups of companies that they are post-tariff in this environment?
Certainly, no, that's not what we're seeing. I don't think you can sort of bake in this level of uncertainty that we've seen. It's very unprecedented from the last several years. We know that companies have withdrawn guidance. Analysts are sort of doing the best they can to predict. Companies are still sort of frozen in terms of a lot of CapEx decisions, hiring decisions. But I think we kind of know at this point the overall tariff rate is probably going to settle somewhere around 15% overall. So that's probably where the market is feeling things right now.
So do you think looking ahead, the risk is that we could see surprise on the upside because all the bad news is baked in, or is it the opposite? As we actually get the impact of that 15 percentage point higher tariff rate, companies have to actually feel that in their earnings.
Certainly, we've seen quite a bit of pessimism, and I think the bears, especially over the past several weeks post Liberation Day, have been proven wrong. So yeah, I think there is sort of an upside risk there as we think about getting past the trade uncertainty, getting the bill passed, thinking about potential, productivity gains as we think about AI and those types of improvements, which again, the time horizon is sort of uncertain there, but let's not forget that that's an overall tailwind as we think about the long-term economic outlook.
So when we think about the bill, honing in on that a little bit more, what areas of the market does that benefit most? Do we see it this year? Is it next year? Or is the impact not really that big and visible?
Well, I think there's two sides we have to talk about the bill. So we, at Mass Mutual, we're very focused on fixed income. So certainly we get a little bit nervous about the bill increasing the overall U.S. debt, which it is going to do to some degree. So we do see that as a risk to, Treasury yields. We've seen the bond vigilantes are back. Certainly, the most beneficial impacts are from the accelerated depreciation, expensing of R&D, and then the consumption boost. We'll see that's TBD in terms of where the deduction ends up, whether we get this temporary boost in the child tax credit. I think a lot of Republicans in the Senate are certainly focused on that increase in the debt, as I alluded to. So that could change certain things like the SALT cap deduction and such as they try to save some money and not run such large of a deficit over the next several years.
And Kelly, I am curious how you are thinking about the fixed income space a little bit more in regards to specific companies. In the notes that you sent over, you talked about Walmart as a potentially attractive opportunity for some investors. Talk to me about why.
Yeah, if you think about the Mass Mutual General Investment Account, we have a $285 billion account, and it's primarily high quality fixed income. So, and 95% of our bond portfolio is investment grade. So when we think about tariffs and uncertainty, we're bond investors. So is a company like Walmart, is our tariffs a challenge? Yes. From a credit perspective, is someone like that going to be able to weather this storm? Yes, they can. And we invest that way from sort of a long-term perspective. And when we make a credit investment, we're really thinking about what's the worst case scenario, and that's how we've weathered many different crises throughout the past several years.
And when I think about a company like Walmart too, I think about the kind of bifurcation of the consumer. And it was really interesting reading about how you do still see continued strength amid that higher income group. Is there anything that puts that higher income group at risk, or is that a narrative that investors can really continue to sink their teeth into?
Absolutely. You make a great point. The top 10% of income earners is driving 50% of consumer spending. And we've seen this trend, continue for the past several months. Certainly the lower income consumer is still struggling with higher prices and, potentially higher prices coming further with tariffs. We do see that trend hanging in there. Obviously, we have seen consumer spending soften a bit. I think we're encouraged with the markets going up post-Liberation Day. We know the wealth effect has been a big driver of consumer spending. So in the short term, we would expect that to continue. But what is holding this all together is really the labor market. And as long as the labor market hangs in there, we think that the consumer, which makes up 70% of the economy, can sustain.
What are your expectations for the labor market? Do you think it should continue to hold up? And then from a price perspective, when are these prices going to hit? And is that going to become an issue that derails the consumer?
I think similar consensus, we do expect to see a softer labor market as we get into the later months of this year. Think sort of, 50,000 to 100,000 average monthly payroll gains. And that's consistent with, the softened growth outlook that consensus has, as well as you saw the OECD just came out this morning with revised down growth forecasts. And that's what we'd expect against this lower growth backdrop. From an inflation standpoint, I don't think we've seen sort of the real impacts of tariffs come through yet to overall economic data. We may sort of see a one-time rise, as certain Fed officials have alluded to. But the hope is that that is not a persistent rise. You would view it as sort of a one point change or 1 point in time change in the price level.
Kelly, really appreciate you joining us, and thanks to Stephanie for the great questions as well. Appreciate you both. Coming up, we're going to look at some of today's trending tickers. We'll give you the news behind those company moves next on Catalysts. It's now time for some of today's trending tickers. We are watching Hims & Hers, Joby Aviation, and Pinterest. First up, Hims & Hers announcing plans to acquire European telehealth platform Zava. The deal will expand the company's footprint in the UK and officially launch it into Germany, France, and Ireland. The all-cash acquisition expected to close in the second half of this year. Those shares up over 3.5%. Next up, Joby Aviation exploring an agreement to sell up to 200 of its air taxis to a major Saudi Arabian investor. The potential deal could be worth as much as $1 billion and could help the company in its efforts to expand into the Middle East. And finally, Pinterest upgraded to overweight from neutral at JP Morgan. The analyst behind the call also raising the price target to $40, saying that diversification of the company's advertising platform does support further upside revenue going forward. You can see those shares up nearly 5%. You can scan the QR code below where you can track the best and worst performing stocks with Yahoo Finance's trending tickers page. We're going to have all your markets action ahead, so stick around. You're watching Catalysts. We've got monthly sales data from several major automakers, including Ford, Hyundai, and Kia. Yahoo Finance senior autos reporter Praz Subramanian has the latest. Praz, let's start off with Ford. You said there was strength, by the way, across the board, but let's kick it off with Ford.
Yeah, so far. Big gains by Ford, but for how long is the question there. So Ford sales up 16%, led by trucks and SUVs. Hybrid surging too, still very popular amongst Ford customers in the U.S. Now, Ford introduced employee pricing right soon after the tariffs were announced. It was seen as sort of a cynical move, but it actually worked. They're eating into market gains. They're getting market gains there through that pricing program. So that's a good move there. The question is how long they can maintain that, right? Price hikes are coming. They've already said models made in Mexico, like the Maverick and the Mustang Mach-E, you're going to get price hikes too. So real quick, also the Korean automakers, Hyundai and Kia, both doing well. Hyundai up 8%, Kia up 5%. Hyundai kept pricing the same through June 2nd. June 3rd now. So the question is, how long are they going to raise prices? Are they going to keep it the same? Can they even cut prices? We'll see.
And what are you hearing about how these companies are thinking through the price increases when the tariff policy continues to change?
I mean, the tariff policy for, at least with autos, has been the same. 25% since April 2nd or 3rd. Now, countries like the UK had a trade deal where they went to 10%, so that's helping them out. So the Koreans and in the USMCA, they're waiting for, can we get some pricing relief here from tariffs? It hasn't been the case so far. The ink is not yet dry or even wet on any of these deals. That's the big question. So I think you're right about with Hyundai and Kia in particular. They're trying to move as much production as they can to the U.S. and that's a tough move. So we'll see, because right now they're probably eating into their profit margins right now, but they don't want to lose customers. They want to lose market gains or some market share here, and that's sort of that balance, right? Is how do I maintain my market share without destroying my profits?
How much of the price increases can they actually pass through? Is it a portion of it, and then how many, percentage-wise? And are some automakers having a different perspective than others in terms of their plan here?
Yeah, so for instance, Porsche, for instance, has said that they want to pass on as much, not they don't want to, but they're going to pass on as much as they can to the consumer, because they have a product set that people want, right? 911 sports cars are highly desirable. You can maybe pass on a good amount of that tariff price change to them. Cars in a competitive price set, volume cars, mid-market cars, you can't pass on that much to the consumer because they're going to get hit by another competitor. Yeah. So that's the problem.
And to that end, which automakers stand to potentially use this as an opportunity to eke up market share from competitors by keeping prices low? Does anyone have that luxury?
So Ford just is blowing it out of the water because they did that employee pricing, and I heard other automakers complain about it. Like, why are they doing that? Well, I don't understand. this is why they're doing it, because they're seeing it as an opportunity to say, hey, Americans, we're going to help you out here. We know prices are coming. We're going to lower prices for you. And that was a good sort of PR, marketing, goodwill move by them. Hats off to them for doing that. Other automakers saying we might want to preserve our sort of pricing power here and our profits here, and maybe do that later. Yeah. And maybe you'll see other automakers follow that in those footsteps. But right now, Ford warned of $1.5 billion in lost profits. GM almost potentially $5 billion without mitigation efforts in lost profits. So that's where we're standing.
Praz, really appreciate an amazing overview as always. Thank you so much.
Thank you.
Atlanta Fed President Raphael Bostic saying there's no clear signs of tariffs boosting inflation as of the April data, but it could begin showing up in the coming weeks. In a phone call with reporters, I'm still joined by my guest host for the hour, Stephanie Roth of Wolfe Research, as the chief economist. Stephanie, I see you nodding your head. Do you agree with that assumption?
Yeah, the tariffs certainly have not shown up yet in the inflation data. They certainly will. It's a question of how much and when, it's not if. So we expect that it will start to show up in the June print reported in July. That's kind of the next step where you're likely to see it. Companies had a decent amount of inventories heading into it, so I don't expect to see it in the next print. But after that, we should very much start to see inflation pick up. Base case is you start to see core inflation run up above, just at least a little bit above 3% year over year towards the end of this year before it starts coming back down.
And if that trend were to continue, does that ever bring a hike from the Fed back on the table in your view?
I don't think so.
Yeah.
The bar for a hike is really high. And at this point, the economy's still slowing. We just talked about how payrolls gains could slow below 100,000. So there's enough out there for the Fed to be in wait and see mode as opposed to something that's more aggressive and hawkish. Mm-hmm. Is there the chance that the market prices in a chance of a hike? Of course. So the bond market might trade in that direction, but for them to actually do it, I think it would be a very unlikely outcome.
And how likely do you think it is that we can enter into that concern that we had about stagflation from earlier this year, that we maybe see unemployment ticking up while inflation is also ticking up?
There's certainly the risk of that, especially as we start to move in the next couple of months when the tariff effects actually start to show up in the data.
Yeah.
The thing is, the economy so far has been holding up fairly well, largely because the tariffs haven't hit. Nothing hasn't really happened yet, even though it's been a wild ride for the first half of the year.
Yeah.
But we do have some positive impulses in the economy, too. One, the labor market, like we talked about, is fairly firm. We'll get a little bit of positive stimulus from the reconciliation bill. Bonus depreciation and R&D expensing should filter into this year. Some of the individual provisions will also filter in. And then there's a little bit of stealth stimulus stuff like the employee retention credit, which was a COVID-era stimulus that's now getting paid out after a long pause. So there's a couple of things that could actually continue to sort of boost the economy, even though the net effect of the tariffs is not very good.
Does the One Big Beautiful Bill lead to stimulus for consumers, in your view?
It does in the near term. The front-loaded effect of the bill is not really for this year, but more for next year, as you do get a bit of a boost from a consumption perspective. No tax on overtime, no tax on tips, some of the child tax credit. So there is some positive impulses to the consumer. It probably could be felt towards the back part of this year. It depends on when they adjust the withholding tables.
Right.
The expectation is, it could be next year, but if you look back to 2009, the withholding tables were adjusted earlier, so there's a precedent for that to happen later this year, which would affect, call it, Q4 growth.
Stephanie, great overview as always. Thank you so much. Really appreciate it. We're going to have all your markets action ahead, so stick around. You're watching Catalysts. Meta plans to fully automate advertising with AI by the end of next year, according to the Wall Street Journal. The news is part of a broader shift toward implementing AI in the tech workforce, a shift that Anthropic CEO says could wipe out 50% of entry-level white-collar jobs over the next 5 years. Here to discuss, Daryl West, Brookings Institution Senior Fellow in the Center for Technology Innovation and author of The Future of Work, Robots, AI, and Automation. Great to speak with you here this morning. Daryl, talk to me about how you would define AI's impact on the workforce going forward.
Well, Madison, I think you're right in the intro, in the sense there are going to be substantial job losses coming from AI. We already are seeing it in entry-level positions. Certainly administrative tasks are easy to automate. Some of the tech companies recently have had layoffs. 40% of the people laid off have been coders. So even in the software area, an area that we used to think was safe from automation is no longer going to be safe.
And talk to me then about sort of the net effect of AI on the workforce here. Is there a potential, like there is with every single technological disruption, of new jobs being created that those coders could then go get employed with?
There certainly will be new jobs created based on some of the emerging technologies, but the problem is what we call the mismatch problem, which is the skills needed for some of the new jobs are skills that many of the people being laid off are not necessarily going to have. So it's really going to place an emphasis on job retraining. People are going to have to upgrade their job skills. And so we're really going to have to devote much more attention to retraining the people for those new jobs that are going to be created.
What do you think about the net inflation impact of all of this? Is it near-term inflationary because we have to put a lot of resources into investing in AI, or is it disinflationary because we have a lot of job loss as a result?
Well, I think workers are going to end up in a worse position in the sense that certainly the people who are being laid off, given the skills that they have, it will be hard for them to find jobs because they may look in other companies or in other organizations. Those companies are going to be doing exactly the same thing. So it really shows that people are going to have to upgrade their skills. It's going to impact the economy, and the numbers could be quite substantial.
Yeah, and those numbers, according to Anthropic CEO, indicating that it could be 10 to 20% unemployment rates going forward because of AI. Stephanie, I'm curious from your perspective, if we do see a continued 20% unemployment rate due to AI, what does that do to the economy? Well,
that would be seriously disruptive and recessionary. I don't think it will necessarily play out that way.
Yeah, how are you thinking about this?
Base case is there will be a lot of disruption. It'll ebb and flow to some extent, so we might be in a period where it ends up being more disruptive and then it gets dialed back to some extent as you realize some challenges. Yeah. Net, technology disruption ends up being good for the economy overall. Productivity is strong. And by the way, we do have a labor supply issue where there's not enough people in this economy. So having AI actually help to rebalance the economy is not really a bad thing.
And we were talking earlier about the impact of immigration policy. To what degree do you see AI sort of as a Band-Aid to the job loss that we're experiencing due to the labor force loss due to immigration?
As we talked about earlier, it's a bit of a mismatch, right? Yeah. In the sense that AI can help with a lot of professional jobs, white-collar jobs, but the jobs that we're losing as a result of immigration is a lot on the blue-collar front, a lot of construction, retail, hospitality. It's the type of jobs that you generally need a person there for, yeah. But over time, that rebalancing could play out and could actually sort of work out, but it takes a while.
Yeah, so Daryl, bringing you back into this conversation here, when you think about the net effect of AI on this workforce, where do you see the biggest potential headwinds? Like if someone is listening to this right now and they are about to enter college and they're listening to this interview, what sectors within the labor market should they be most concerned about going forward?
I mean, where we already are seeing job losses are in the coding area, in finance, in basic administrative tasks, but it's not just the entry-level positions that are going to be at risk. For example, there is AI that actually has gotten really good at reading X-rays and CAT scans. And so even a very professional occupation like radiologist, there could be some risk there. Certainly in the finance area, accounting, those types of transactions are fairly easy to automate. So it's not just going to be entry-level people who are at risk. So young people thinking about their careers should think about what are the jobs that are repetitive. Those are going to be automated. Those will be at risk to AI. Other types of jobs where there's more creativity involved, where there's less uniformity, those jobs will be safer.
From a college student's perspective, what might be areas that they could actually consider studying that would benefit from AI rather than the concerns of where there might be job loss? But where is there going to be job creation?
I think there will be many areas that will benefit from AI. I think in the short run, AI is more likely to augment human performance as opposed to replacing it. So virtually every sector is going to see AI coming into it. In the education area, we're seeing that there are a lot of research and writing tasks that can be automated. And so people need to learn how to use AI for their own benefit in those areas. So I think those are some of the areas that I would keep an eye on.
And Stephanie, curious what you think about entry-level work being under pressure. What impact does that have longer term? If folks can't have that entry into the labor market, then where do they go?
Yeah, that could become a problem. It could create a bit of an air pocket where there is a near-term period of time where we don't have these entry workers, and they're not trained to do the more senior tasks, which still require a person. So, base cases, this could create a little bit of disruption at the sort of that lower end sort of assistant type of work. I don't expect it will dramatically change the labor force. I think it will be more about augmentation, make us more productive, rather than significantly disrupt the labor force, particularly for that younger worker.
Yeah, and Daryl, I want to give you the final word here, particularly as we continue to hear from our sources about pushes for regulation from Washington on AI and the potential for AI to replace parts of the workforce. What would you tell regulators to keep in mind?
I mean, I don't think the government is going to be able to stop this trend just because it is so pervasive and the innovations are getting better and better. But what government can do is to help on the job retraining front. That's a task they traditionally have done. They need to work with local employers so that they're retraining people in the right way and for the right skills. I think that will probably be among the most constructive things government agencies could do.
Daryl, really appreciate your time this morning. Thank you so much, and thank you to Stephanie for joining the conversation as well.
Thank you.
A year after Apple announced its foray into the AI space, investors aren't expecting much in terms of new AI announcements from the company at next week's WWDC. Tech editor Dan Howley joining us here with more. Dan, we were just talking about your preparations for the big trip. Not expecting a ton of AI headlines, though, from Apple. Why is that?
Yeah, no. This is kind of the year, kind of taking a step back from AI a bit, just because we had the big kind of announcements about Apple Intelligence last year, and it hasn't all panned out the way it seemingly was supposed to. The new Siri with generative AI, nowhere in sight yet. We don't know when that's going to be available. Apple said it's delayed because they still have more work to do. The tools that they have, the writing tools, things like that, the image kind of cleanup features, those are kind of par for the course now when it comes to generative AI. It's nothing really, mind-blowing, and it seems this year it's just going to be more about changing up the operating systems, or at least improving them, rather than adding AI. So this is, according to Bloomberg's Mark Gurman, there's going to be updates to all of the operating systems as far as design. What that means is it'll look more like Vision OS, which is the operating system that powers the Vision Pro. We all have one of those, by the way, right? $3,500 Vision Pro. They're also changing the names of the operating systems. They're opening up their third-party AI models to developers. So that may be something that gets people excited about AI, just knowing that Apple at least is trying there to get more developers in and see them develop more apps. And then there's other features like live translation on AirPods and a battery charging feature that's AI based. But it seems to me this is a moment where it's almost a pause on Apple being big and ambitious when it comes to AI. Kind of like, okay, we did that last year. We're still waiting on the outcome of that. Let's hit you with some other stuff in the meantime. And it's a question of where does that leave Apple, because Google just had their I/O conference, showed off a slew of new AI features. Microsoft just had their Build conference, same thing there. Apple, this is their developer conference. They're going to have to prove that they have what it takes to really kind of keep up.
Well, also what I wanted to talk to you about is Johnny Ive's OpenAI device as well, and how much that potentially raises the bar for Apple this coming week in terms of potential competition out there.
Yeah, I mean, it's interesting, right? We have no idea what this device is going to be, what it looks like. There have been other devices that are based on generative AI technologies, but they've been, frankly, flops. There was the Rabbit R1, the Humane pin. Obviously, HP kind of sucked up Humane and the technology there. I think that the fact that Johnny Ive, obviously working on it with Sam Altman, adds more cachet to it that the others necessarily didn't have. I don't know if that means it's an existential threat to something like the iPhone, but it certainly is a threat to Apple, just because of the prowess of Johnny Ive and his design capabilities. And I think that just, again, adds to that pressure that Apple is under to deliver something on the AI side of things, right? I mean, they talk up about how their chips can handle AI. They talk up the AI features that they've added, Genmoji, but that's not really stuff that's going to get people out to buy any phones or devices. I will say, nothing out there is worth really buying right now, based solely on the generative AI capabilities that they have, right? New laptops from Microsoft, they have Gen AI capabilities, but you would buy them because they're better laptops. The Qualcomm chips in them. That's really good. That's matching up with what Apple has to offer as far as capabilities with the Macs. Google's phones are great. Obviously, Samsung's phones are great. They have AI. Nothing in it really says, hey, go out and buy this phone because of these AI features. So, Apple is behind, but it's not behind to the detriment of sales.
Really great overview as always, Dan, and we're excited to chat with you next week when you're over at WWDC. So thank you so much, and safe travels, of course. Yes, exactly. Thank you. Coming up here, how tariffs are weighing on small and mid-cap companies this earnings season. More when we come back. Mid-sized companies increasingly mentioning tariffs on earnings calls. Members of the Russell 3000 mentioned tariffs on earnings calls over 5,000 times in the month of May. And as we head towards the final 30 days of the 90-day reciprocal tariff pause, what does this mean for small and mid-cap investors? I want to bring in Mike Casper, Bloomberg Intelligence Sector and Small Cap Equity Strategist. Great to have you here, Mike. Talk to me about what it's going to take for small caps to outperform again, especially given not only the tariff uncertainty, but the macro uncertainty that's causing as well.
Yeah, well, there's two things I'm really watching. One is the Fed, and one is our fundamentals for companies, right? So fundamental growth for Russell 2000 companies has to be stronger than the S&P 500 just to start for small caps to outperform. We haven't really seen that since 2018, 2019, and the 2021 recovery period after the 2020 recession. So we really need to see fundamental growth pick up. Now, we started to see some of that in the first quarter, but a lot of the revenue growth that we saw in the Russell 2000 might have been pulled forward from this tariff hit, right? So if you think about how companies are going to brace for tariffs, they're going to buy products in advance of the tariffs hitting, trying to get ahead of some of those tax consequences and build up inventories. So the question is, going into the second quarter earnings, was that a buildup or was that actually organic growth? And we'll see more as we get more results.
Yeah, and Mike, I hear you talking about something that we talk about so often with our sources, that it's just really hard to tell with regards to tariff policy that is constantly changing, and also whether it's a pull forward dynamic or indicative of something else. Given the uncertainty that tariffs create for small and mid-cap companies, should investors be looking at specific stocks more so than the broader index in this environment? And if so, what's the best way to do that?
Yeah, so if you're talking about specific stocks and sectors, I tend to focus a little bit more on sectors. Across the board, both in mid caps and small caps, and even in large caps, tech is the most foreign exposed sector across all of these three indices, the S&P 500 and the Russell Mid and the Russell Small, right? So tech is one that can be very badly hit, right? Now, we've had some reprieve on the tariff front for tech specifically. Trump's gone back and forth whether there's going to be tariffs on semis, and he's pulled it back, and he said it's going to come at a later date. So there's a lot of uncertainty around that. But if there are specific tariffs on tech products, it would be pretty disastrous for the sector. Now, in terms of small and mid-cap companies specifically, they do have less foreign exposure significantly than large caps, right? So when we're talking about cost of good exposure, for mid-cap companies, we're talking about 40% of the index has cost of goods exposure outside the U.S. That's in contrast to nearly 50% for the S&P 500, and it gets even smaller as you go to the Russell 2000. And when we're talking about revenues, so reciprocal tariffs, tariffs China might put on the U.S. and so on and so forth, small and mid-cap companies are only about 20% revenue exposed to foreign entities, whereas the S&P 500 is about a third exposed. So there is significantly less exposure down cap. Whether that translates to fundamentals is yet to be seen.
What about on the reconciliation front perspective? Is that going to benefit your space? And especially since R&D expensing and bonus depreciation could be a potential boost to CapEx this year, could that benefit your space at all?
Yeah, our R&D exposure definitely could benefit the space. The issue is, with all the tariff uncertainty, do companies pull back on their research and development and their CapEx plans, right? So it was something that I was really watching, especially in large cap earnings in the first quarter, were these tech companies that, again, are very exposed to foreign sales and foreign COGS exposure, where are they going to pull back on their CapEx? And we didn't really see that, right? So, Microsoft kind of reaffirming their plans and some of the other large cap tech companies reaffirming their plans. I saw that as a very good sign and could benefit small cap companies going forward if they do continue to spend at the pace that they are spending.
I want to end on one of the headlines on your notes that you worked on with Gina Martin Adams, another friend of the show. Stalling economy may be worse for stocks than a failing one. Explain that to me, Mike.
Yeah, so a failing economy, right? You get the washout very quickly and you get a recovery very quickly. If you think about recessions that were very V-shaped, for lack of a better term, so 1990 was pretty V-shaped. 2020 was probably the textbook example of a V-shaped recession. We had the complete recessionary washout. Within 2 months, you get a very quick recovery and stocks tend to benefit, and the Fed has very high clarity on what they need to do to reaffirm the outlook for the economy and subsequently for stocks. If you get a stalling economy, it's a very dragged out experience. Think about your 2008, 2009 recession or your 2000 through 2001 recession, where stocks didn't recover for 5 or 6 years off of that recessionary low because policymakers don't have as much clarity on what they need to do, and so on and so forth. So really, if you get a quicker washout, it tends to be better for stocks. There's a quicker chance of recovery.
Mike, really appreciate you making the time and breaking that down for us so well. Thank you so much.
Thank you.
And a big thank you to my co-host for the hour, Stephanie Roth of Wolfe Research, as the chief economist over there. Always appreciate your insights. Thank you for making the time for us.
Thank you for having me.
Of course. Coming up, we've got Wealth. It's dedicated to all your personal finance needs. Brad Smith has you for the hour. Stay tuned.